We equate financial security with preservation. We assume that as long as the principal amount remains untouched behind a vault door, we are protected. But there is a vast difference between the psychological safety of a static bank balance and the mathematical safety of actual wealth retention. That assumption of safety ignores the silent math of inflation. Consider a simple daily purchase. In 2010, a liter of toned milk cost 25 rupees. Today, that exact same liter costs 45 rupees. This chart shows how inflation destroys stagnant capital. The flat line represents the nominal value of cash in a bank. The number never shrinks, but the red area beneath shows your purchasing power steadily bleeding out at an average rate of 6% a year. A deposit that simply holds its numerical value while the cost of living doubles guarantees a severe shortfall in future purchasing power. Relying strictly on traditional savings mathematically guarantees you will be unable to afford your own retirement. Recognizing this trap, many impatient investors are aggressively pivoting to the opposite extreme, turning to social media for quick-fix stock tips. A massive subculture of financial influencers has emerged, promising 30-day trading returns and get-rich-quick schemes designed to bypass the boredom of traditional saving. This explosion of unchecked advice recently triggered a sweeping crackdown by SEBI. SEBI is the Securities and Exchange Board of India, the primary regulatory body overseeing the country's securities and commodity markets. To protect retail investors, the regulator issued strict new mandates. They have explicitly restricted live trading sessions and unverified stock recommendations by any individual who is not formally registered as an investment advisor. Taking unverified tips often means trading on manipulated or fabricated data. A single bad trade built on this hype regularly leads to massive capital destruction. Attempting to escape the slow decay of a bank account by jumping into unregulated social media hype does not solve the problem. It simply replaces guaranteed stagnation with guaranteed ruin. To properly evaluate long-term wealth generation, we have to look past the cultural myths and the social media hype and rely on an objective academic framework. A recent comparative analysis published in a UGC Care-listed journal examined historical returns, inflation rates, and tax implications to determine the actual yield of equity funds versus traditional fixed income instruments. This table from the study directly compares the performance of major asset classes. Looking at the fixed deposits row, we see a standard pre-tax annual return of 5 to 7%. The appeal here is the complete absence of day-to-day volatility. But there is a fatal flaw in the math. The interest income from these deposits is fully taxable according to your individual income tax slab. For high-income earners, that tax burden instantly crushes the actual yield down to a mere 4 or 5%. Compare that to the historical performance of equity mutual funds tracking the Nifty 50. The Nifty 50 is a benchmark index representing the weighted average of 50 of the largest and most liquid Indian companies listed on the National Stock Exchange. Over the long term, this equity benchmark delivered an average pre-tax annual return of approximately 12%. Equity mutual funds, by successfully clearing that threshold, are the only mathematically viable engine for actual growth. Abstract annual percentages on a spreadsheet often fail to convey scale. To understand the true impact, we have to look at the hard, cumulative monetary outcomes over a 15-year period. This bar chart displays the total cumulative growth of a 1 lakh rupee investment. If that money sits in a fixed income instrument for 15 years, it reaches roughly 2,30,000 rupees. If that exact same 1 lakh rupees is invested in equity funds over the identical 15-year timeframe, the total post-tax growth reaches 5,50,000 rupees. This massive disparity in capital accumulation is the reality. It exists despite the heavy taxation, and it exists despite the turbulent nature of the stock market. Avoiding the stock market for the sake of perceived safety carries a literal calculable cost. It costs hundreds of thousands of rupees in lost compounding potential. If equity is mathematically superior in every way, why do so many everyday investors fail to achieve these returns? Because equity has a hidden cost: volatility. Earning that 12% return requires enduring terrifying short-term market crashes, where your portfolio value will temporarily plummet.
Finfluencers sell the lie that you can time the market to avoid these drops. But academic data proves that consistent, automated investing through SIPs is the only reliable defense. A SIP, or systematic investment plan, is a method where you invest a fixed amount of money at regular intervals, regardless of market conditions. True wealth creation demands extreme emotional discipline. Ignore the daily noise, tune out the panic, and refuse to sell your assets during a downturn. Investors do not earn a 12% premium because they are financial geniuses. They earn that premium strictly as compensation for their psychological endurance. This matrix charts out optimal asset allocations based on your specific life stage, mapping what financial vehicles to prioritize based on your age. For the aspirational earner in their 20s and 30s, the primary structural advantage is time. Your investment horizon spans decades. At this stage, you should maximize equity SIPs immediately. The short-term noise of social media trading is irrelevant to a 30-year timeline. As you transition into your 40s, the mid-career saver hits peak income tax slabs. The strategy must shift toward tax efficiency and stabilization. Rather than retreating to the nominal safety of fixed deposits, the focus should shift to tax-efficient equity integration. Techniques like tax loss harvesting become essential to outpace inflation. Tax loss harvesting is the practice of strategically selling off underperforming assets at a loss to legally offset the taxes owed on your capital gains. During your accumulation phase, time is your ultimate shield against volatility. Refusing to engage with equity during these critical decades is the single greatest risk to your future security. This decision tree outlines the transition for pre-retirees in their 50s and beyond, who must urgently pivot from wealth accumulation into wealth preservation. Moving 100% of your portfolio into fixed income the moment you retire is extremely dangerous. Because inflation never stops, a completely fixed return guarantees you will eventually outlive your money. To survive this phase, you must calculate your safe withdrawal rate. The safe withdrawal rate is the percentage of your portfolio you can extract yearly without depleting the principal. While the global standard is 4%, the specific rate for India sits between 3.5 and 4.5%, accounting for higher domestic inflation. A secure retirement strategy requires a robust fixed income baseline to prevent capital drawdowns during market crashes, paired with a smaller dedicated equity sleeve to prevent your principal from eroding due to inflation.
Real wealth is not built by chasing social media hype, and it is not preserved by hiding cash in bank vaults. Rather, it is built by deliberately aligning your own psychological endurance with the mathematical realities of the stock market.